So maybe turning it around just a little bit, I want to talk about this idea of smart capital, right? Because people talk about, oh, capital is out there and there's lots of places from where you can get money. But what really defines smart capital? I mean, Miles, maybe I'll start with you. You talked yesterday about sort of some of the advantages you and Baris were articulating around corporate venture. But in general, what should entrepreneurs look for in investors besides the money? What kind of value add? What kind of things are important?
Yeah, so I would say that you really want some domain knowledge, and you want to also be able to sort of use the connections that the investors have, and obviously your board as well. And there was some discussion around having someone who has domain expertise, but I think also that having connectivity, the entrepreneur needs that, but also the investors do as well. So when you're in a board meeting, when you're talking about, this is an area you want to go after, you want to be able to have those investors say, hey, look, I can help you by doing X, Y, and Z. Yep. Or, I wouldn't do that because I've seen this happen in the past. I would think about it this way. And so I think you really want, instead of just money and then someone who's going to maybe very smart sitting there but doesn't necessarily know anything about your domain and what the area that you're going after, you really want someone who's going to be a partner with you, who can help you as you're trying to make these tough decisions. And if you have to pivot, then, they can help drive that. They can maybe get you the right connections. There's one of my portfolio companies that we've got a product, and they're having a hard time with some of the packaging around a component. And I was able to turn around and work with some of our packaging engineers who have very deep expertise, who have all of software ready to go that a startup can't afford. And I could turn around and say, hey, packaging engineer, can you take a look at this and try and help these guys? And we've got 2 or 3 people who can then help the startup. That's sort of one example, but also these connections I think are critical. So I think you really want to identify a partner who's not just going to give you money, but really can be sort of an integral part of your success and really be a key partner to help drive you as things go forward.
Sure. So domain expertise and relationships are a network, right? So what they know and who they know can be good. Anything else to add, Mustafa?
Not really. That's domain expertise and the network effect.
Evan?
I would add a couple of things to this. I would say, firstly, expectations are very important. You don't want the investor to push the company in one direction and you want to go into another direction, or the company needs to take its time to grow and the investor is pushing for something to happen in a year or 2, or vice versa. It's very important that the investor coming in understands the entrepreneurs, what they're capable of, the company, how it should grow. A lot of people go from their own experiences, and that can be both useful and sometimes detrimental. So I think it's very, very important that on day one, everybody's expectations are similar, at least in terms of the road ahead. Obviously, there is always going to be interesting developments. Secondly, I would agree definitely expertise, network, and a lot of the different assets that a good investor, VC, can provide that an entrepreneur may not have. And I think those assets can be very different, whether it's a local e-commerce company or a software company which needs to tie into Silicon Valley and make those kinds of connections. So I think it's very important to realize that an investor that's very high value add in particular venture might not be so high value add in another. We try to, don't want to do propaganda here, but we try to build a team that combines a lot of different elements, because the kind of expertise and network you need for a software company is very different than the one you need for a local retail e-commerce company. Thirdly, I would say effort. At least that's my own personal view. If I won't invest into any team that I don't think is 150% dedicated, and if they are like that, I will also be like that, and we will be like that. So if they don't sleep, I don't sleep. If they work hard, we work hard, and need to make sure that they succeed. Obviously, there's always unforeseen events, but I think everybody on the party who is committed needs to be equally committed and needs to almost religiously believe in it and give their 100%. That would be my number 3. And number 4, I would say, would be good intentions. I have seen in a lot of cases where a lot of energy spent between different shareholders and investors into kind of fighting with each other or maximizing personal value, and I find that can be very destructive. I think it's very important that the investors set an example by always thinking of the company first, and so the entrepreneurs always feel like all they need to worry about is the company, all they need to worry about is to succeed, and they will be taken care of. So I think that's also very, very important. I would say that that is one thing that where maybe independent VC firms are in a slightly better position than corporate VCs, who are typically also independent and well-mannered, but they can be perceived to have other strategic interests. It's also the case with other different types of investors. So I would say those four things are extremely important, especially for the entrepreneur.